You are welcome to my channel. This is Kevin Davis Accounting. But before we proceed, subscribe to my channel, subscribe, share to your friends so that they can also have a benefit. So, we are still continuing with our series on single entry and incomplete records. Now, in the previous video, remember I told you about the net worth method. So today, I would like us to look at another method, which is the conversion method. Like I told you, it's the information that they give you that determines which kind of method that you are supposed to use. Now, when it comes to the net worth method, I say that in the net worth method, this is where the information that I've given you is not adequate to prepare final accounts. So it's not adequate to prepare the income statement. It's not adequate to prepare the statement of financial position. So now, when it comes to the conversion method, other than the net worth method, here, actually, we can prepare the final accounts because the information they give us, actually, we can use it to prepare the final accounts. Now, I'm going to give you about 4 or 5 steps that you're going to use. That when you achieve these steps, actually, you are good to go and you cannot fail such a number. So, 1, these are the steps that you are supposed to follow. 1, establish the sales figure or the total sales. Now, remember, when we are preparing the final accounts, let me say, for example, the income statement, there's certain items that we need. 1, they are the sales. Remember, we're supposed to get the net sales. Then we subtract it from the cost of sales. Then to first get a gross profit. Then we shall add on other incomes. Then less our expenses so that we can get our net profit. If you're not well versed with that topic, you can just go back and watch my video about final accounts. Then come back and watch this. So, when we establish the total sales, now the total sales actually is a sum of credit sales and cash sales. So, the question is, how are you going to establish this? Now, very many times in the questions that you're going to find, they will always give you the cash sales. But now, it will be on you to calculate the credit sales. Now, how do we calculate that credit sales? Now, from your knowledge of control accounts, we are going to prepare what they call a debtors control account. Now, this is the same as the sales ledger control account. Now, remember, from your knowledge of control account, it looks like this. So, this is what they call a debtors control account. We get? So, basically, we always have our balance brought forward here, and then we shall have our balance carried down here from your knowledge of control accounts. Now, when it's like this, remember, we have items. Now, it's your duty to go through the question to find which items go into the debtors control account. So there could be quite a number of items, but very many times they're always like 3 or 2 that come into the debtors control account. Now, we can have items like, for example, when it comes to such a number, they're going to give you what they call the cash book, or what other people call receipts and payments. So, in the receipts and payments, you will find out that you have actually trade debtors in your receipts and payments. Now, those trade debtors will be on the debit side. So, that means that is cash received from the debtors. So if it is cash received from the debtors, actually that reduces the amount of debtors. For example, it reduces the amount of money that you are expecting from the debtors. So what do we do? Because it's on the debit side in the receipts and payments or in the cash book, we come and indicate here in the debtors control account as cash received. So we show it here. You see? Then we can also have other items that we are supposed to put here based on the question that I've given you. For example, we can have a discount allowed. Remember, discount allowed is us giving the discount to the debtors. So the discount allowed actually reduces the value that these debtors are supposed to pay. So we come here and say discount allowed, and then we show it here. Then we also have an item they call returns inwards. So these are debtors actually returning goods. So that means they took goods on credit, but they are returning those goods. So when those goods are returned, actually, it means there's a reduction in the amount of money that we are expecting as receivables or from those debtors. So it will come here and say returns inwards. Then we put it here. So, just like you see it here, we are going to balance off our debtors control account. So, when we balance it off, realize that the credit side will actually be bigger or heavier than the debit side. So, now, you cannot have another balance carried down. No, you cannot have it. So, because we already have a balance carried down. So, what we are going to do, the other figure, the balancing figure, we shall put it here and we shall call it credit sales. So, by doing this, we have actually established the credit sales. So, that means we shall get these credit sales. Then we go to the receipts and payments or the cash book and we get the cash sales. Then we shall find the total of the credit sales and the cash sales, and that's what we are going to take into the income statement. I hope that's clear. So we shall take this plus the cash sales from the receipts and payments, then we shall have our total sales. That's it. Then the next we shall have, after us establishing this, 2, we are required to establish the total purchases. And still, just like I've told you, when it comes to the sales, when it comes to the purchases, total purchases, we shall also have credit purchases plus cash purchases. These are still purchases. To remember, in my introduction to financial accounting video, I told you we are running a business and we have transactions. So the two kinds of transactions that we have credit transactions and we have cash transactions. And I said that the cash transactions, this is where money is made on spot. But when it comes to the credit transactions, this is where money or payment is deferred. Payment is to be made at a later date. You see, so when it comes here, most times still, the cash purchases will be given to you in your receipts and payments or in the cash book. Now, what we are required to establish is the credit sales, the credit purchases, sorry. Now, how do we establish the credit purchases? Still, we are going to draw up what they call a creditors control account. So, we come here and say, our creditors control account. Now, as you know, the creditors control account, the balance brought forward, or it always has a credit balance, a normal credit balance. So we shall come here and say our balance brought forward is on the credit, so we shall indicate it here. Then that automatically means that our balance carried down must be on the debit side of the account. So we come down here and say balance carried down and we indicate it here. Now, mind you, all this will be given to you in that question. Because there will be a list of balances. Remember, now the list of balances we shall have opening and closing, which is 1st and 31st December. So, if it's balance brought forward, it will be as at when you are beginning. This is the balance that you are being here, then you shall have the closing balance. So we start to adjust our creditors control account. We have items that are supposed to come into the creditors control account. For example, we can have cash paid. We indicate it here. Then we can have items like discount received. We indicate it here. Then we can also have items like returns outwards. And so forth and so forth. So for this time, let us take this. Now, we are required to find the total here. So we come here and say the total. Of course, this side has to be heavier than this side. Now, like I told you in the debtors control account, we cannot have another balance carried down. No. So what we have, the balancing figure, all that the figure is remaining, we shall bring it here and we call it credit purchases. And we shall bring our figure here. Ladies and gentlemen, we have established our credit purchases. Now, this is the figure that we are going to add to our cash purchases for us to come up with a total purchases. Remember, we're supposed to prepare an income statement. So we need these purchases as well, the total of the purchases. Now, this one, the credit purchases, we are going to add them to the cash purchases, which are in the receipts and payment account, or which is the cash book, and we shall find the total purchases. So that's what we have here. Then, after that, I would like to talk about what I call expenses. Actually, I'm going to talk about expenses and incomes at once. Now, so for example, there might be what they call prepayments and owings. Now, following the accrual concept, that money is supposed to be recorded as it is incurred, not when it is paid. So, it means we are supposed to actually establish how much was incurred, not how much was paid. Because like I told you, we can have rent, you can pay for a month you have not utilized. Then that means you have paid that amount, but you have not incurred that amount. So what do? We are supposed to prepare what they call an expenses account. Now, this is how it looks like. So this is how it looks like. Now, remember, we have two things here, and I would like to talk about them in the same thing. For example, if an expense, let's say like rent, is prepaid, what do? Remember I told you in the introduction to financial accounting video that if something is prepaid, it is an asset. So, like you know that all assets have a normal debit debit balance. So, if it is prepaid, now I'm using expenses as a general word, but it could be an expense they give you because they are going to give you different expenses. Let me say they will give you electricity, they will give you salaries, they will give you rent, whatsoever they give you, that's what you're supposed to put. But right now I'm using expenses as a general word. So, if it is prepaid, you come and say balance brought forward, and in case that is prepaid, it is always on the debit side. Now, meaning that balance carried down, prepaid still, will always be on the other side. You see? Now, look at this. This applies for the prepayments. But we can also have an item, an expense that is owing. For example, we can have salaries that are owing, that are outstanding. So if it is something is outstanding, remember, this is a liability. So if it is a liability, I told you that liabilities always have a normal credit balance. So if it's the other way around, and you find an expense, for example, you can have very many expenses. One is prepaid. So when they give you one which is prepaid, this is how you're supposed to present it. But when they give you another which is outstanding or owing, you come and say balance brought forward for that expense which is owing, and you indicate its opening balance here. Then that means the closing balance has to be on the opposite side. So you come in and say balance carried down. Of course, it's owing. You bring it here. Now, listen to me. When they give you items of let me say expenses, if there are 5, you're supposed to prepare 5 accounts of those expenses. Each expense with each account. So it means you might find that one expense is prepaid. If it is prepaid, this is how you're supposed to prepare it, the balances. Then if you find another expense and it's owing or outstanding, so you're supposed to prepare it this way. This is how you're supposed to open its account. Then remember this expense. Now when you go to the receipts and payments, they will always give you a cash amount for these expenses. So what you do is, since that amount is given to you from the cash book or receipts and payments on the credit side, remember those expenses, when you go into the cash book, they're always on the credit side of the cash book or the receipts and payments. Now when you come here, you record them on the debit side of the account because we are getting them from the credit side. So you come here and you indicate, for example, you can put here cash book, or sometimes people can indicate what? Receipts and payments. So you get that value from the cash book, that same value, you bring it here. Now what you do, you add up the total. Basically this side of course will be heavier than this side. Now the amount that you get, the balancing figure here, we shall call it income statement or profit and loss. Some people show it like this, profit and loss account, meaning that some people call it income statement, meaning when we go to the expenses, when you're preparing the income statement, when it comes to this expense, this is the value that we are supposed to take. This is the value that we are supposed to take the income statement as expense. So this is how it's supposed to be. Then now I've told you that I'm doing this account for 2 expenses, one which is prepaid and the other which is owing. So don't be confused about these balances. So now this is how it's supposed to be. Now when it comes to the incomes, let me do it here as well for the incomes. Now rarely shall we find questions demanding us to have incomes prepaid, rarely. But in case it comes, because we're not going to gamble, let us have our understanding enhanced. So in case you find it, this is how it's supposed to be. Now expenses and incomes, they look exactly opposite. For example, if the balance prepaid here was on the debit side, here it will be on the credit side. So we shall have balance. Of course, this is the incomes account. Because now this one here, if it's prepaid, it's a liability. Remember, if they pay you before you deliver a service, it becomes a liability. Now, of course, the balance carried down will be here. Now, on the contrary, of course, now this is prepaid. On the contrary, if it is balance brought forward, owing, meaning you demand this amount of money. So if you demand this amount of money, then it is an asset. So we show it here. Then we shall have our balance carried down, of course owing, we show it here. Then what we are going to do, we bring in our income. Since it's an income, so we shall bring it here and we shall indicate that receipts and payments, or what others call cash book. So we put the value here. That means the other value, the balancing figure, after balancing off here, the other figure that we shall have, we shall call it income statement or profit and loss account. Profit and loss account. Now, this is the value that we shall take under incomes on our profit and loss account or the income statement. So basically, that's what we are supposed to cover when it comes here. Now, there is one more thing I want to cover before we continue. One more thing, and it's called when you're preparing this, we are supposed to prepare the statement of affairs. Now, here, when we are preparing the statement of affairs, actually we are going to prepare using the opening balances. Now, we are looking at establishing the opening capital, not the closing capital. As much as the statement of financial position is going to be at 31st December, the opening capital is required to be actually all the other items in the statement of financial position should be as at 31st December. That means we shall have closing balances for all other items in the statement of financial position except capital. Why? Because we need to know how much capital was injected in the business. So when we get to know, then adjustments are going to be made on that very capital. So if we are to do maybe purchases, everything is going to be made on that capital. That's why we need to take the opening balance. So we are supposed to prepare the statement of affairs. Now, this is just the procedure that you are going to follow. When you do this, trust me, there's no number about single entry and incomplete records that you cannot solve. So in my next video, I want us to solve a question on the conversion method. And we see how it's done. I know it's a bit hectic, but it's always in our reach and we can solve it. So thank you so much for watching. This is Kevin Davis Accounting. Subscribe to the channel. Make sure you share to your friends. Let them have a benefit and learning. Goodbye until we meet again.